Welcome. This presentation is designed to benefit new traders, advanced traders, and managing directors. You can experience significant insights along the way which will enable you to answer the quiz questions seen here and a heck of a lot more. So please pay attention as significant insights are sprinkled here and there throughout the presentation. Let's get started. Alan Andrews was an absolutely amazing man. He could look at a chart like this and give very accurate forecasts. Fortunately, he documented all this on what he thought at each moment in time and as he was trading and as he was teaching, and he left us insights to his brilliance which were documented in real time. This is what this documentation of brilliance looks like. It's the material in the expanded course. It's derived from the massive original library of the weekly notes, newsletters, and charts of Dr. Alan Hall Andrews. Here you see hundreds of documents all laid out on a table ready to be sorted. The contents of the massive written material goes far beyond what was presented at Andrews Live seminars, which I attended, by the way. It goes into the real-time thoughts, insights, and techniques of Andrews that he wrote about over decades. Now, it's a total of hundreds of pages that we organized by date and other factors to make research in this massive amount of information as easy and practical as possible. After the pages were well organized and photocopied, they were put into volumes. This is what one of the hundreds of pages looks like. This is where Andrews wrote by hand how to do exactly what he did. Each expanded course set of volumes comes with an Andrews wet ink document, primarily for collectors. What you see right here is a photocopy of one of these in the manual. Eventually, my library of originals, including the original of the document you see here, will be donated to the library of an institution like MIT, where Alan Andrews and Roger Babson attended. Also, fortunately, most of this material here was typed, not handwritten. What we did was we printed photocopies of the massive number of documents. There's nearly 1,000, by the way. And they're organized into 3 volumes, and anybody who gets this from us also receives access to the 26 or more videos that focus upon the material in the 3 volumes. Let's leave that. So what else is included with this? Well, the massive volumes have techniques not discussed elsewhere, videos to help you understand the written material better, and these videos cover various techniques, patterns, and setups. What's significant is the original written material includes letters, charts, and specifically scripts, and the scripts are what's important, to read to brokers that Andrews would send out prior to 1976, which covered this demonstration he did once a year, where he, almost like turning water into wine, he turned 5K into 50K in a few months in these demonstrations. And so what exactly is the 5K to 50K demonstration? Andrew would send out a typed newsletter on Thursday by U.S. mail with a script for students to read to their brokers on Monday morning. Now, over several weeks, he would demonstrate turning 5K into 50K from trading in the letters. And I'll show you that exactly in a minute. Along with the script, he would show his logic and explanations for what he did and why. His trading logic was explained in real time, a kind of, here's why I'm doing this with charts. Let me show you. Yeah, there we go. Okay, now what's in the videos? Oh, Jesus. What's in the videos? Many topics, in addition to how to determine the OR points. These are what Andrews in the 1970s wrote was the best technique for entering the markets near the extreme or pivots. Let's start this again. What is in the videos? Well, in the videos that comes with this stuff are many different topics, but in addition to how to determine, there's also how to determine, there is how to determine OR points. These are what Andrews in the 1970s wrote was his best technique for entering the markets near extremes of pivot points. He named it OR because he considered it to be like gold. Also covered are the patterns and techniques he may have used to determine orders in advance. Let's see what the heck we're talking about here. Well, this is a chart, what I call a daily OR chart. This was posted on Andrew's course WordPress blog site. Okay. And at the time it was posted, we had this much data. This is what I was looking at in the market, and I just snapshotted it and put it up there. The OR indicator that Andrews wrote was the best technique for entering the market to get in near the extreme of a move. That's what he wrote. He wrote about it, this particular method, for several weeks, giving lots of details and stuff and showing exactly how to use it. And then, and this was in the spring of late winter, spring 1974, and then in the spring of 74 he wrote that it was reserved for use of charities and educational institutions. Thereafter he stopped writing about it, and this particular OR chart was posted on the Andrews Course blog site. So, excuse me. One of the things we looked at is it possible to use this intraday, on daily, on weekly, when we start doing research on this stuff. Well, this was a chart that was sent to course members in the discussion group. This is the Advanced Andrews course on November 25th that noted 2 intraday OR points and 1 daily OR point near the low around 1150. So here was an OR point up here, here's another OR point, and then there was one down here. For whatever reason, I didn't try to get these low ones here. What I was mainly looking for was doing this kind of the chicken way, in that this was a correction from this very, very swift down move, and this was a correction, obviously, of a rather substantial down move, and this here, where I wrote Janish reversal line, was another correction point of a very swift down move. I'll show you all that in a second. Anyway, we experimented with the OR techniques on daily, hourly, and weekly charts. See what I mean? I mean, the market was going like, okay, and as you can see, we're in the 1150 area, and so the market was coming down to here, where with this final line I labeled Janish reversal, which is nothing more than an OR line, came in right around here. So this is what we were experimenting with at the time. Now, with his, okay, moving on. What was the technique used in Andrew's 5K to 50K annual demonstration in his newsletter? Well, starting in the 1960s, Andrews would send out a written newsletter on Thursdays, like I said, and this demo was on for a few months each year. And it was kind of a marketing technique, a fascinating marketing technique. It contained a script for his students to literally read to their brokers on Monday morning. I will actually show you some of these. How did he do it? He might have noticed a pattern like the one above. Let's take a look at this. Here's a pattern. Okay? Now consider this. If this is, let's say, Thursday, if this is Wednesday or Tuesday, and then this is Thursday, now this is, let's say, Tuesday, and this is Wednesday, this is Thursday, Friday, Monday, Tuesday. I mean, there's just a whole lot of time in here for him to look at the market after it closes on Thursday and say, well, because of this pattern here, there's a high probability prices are going to go down. And so what I'm going to do is I'm going to put a sell order in here. When prices get back up here, this should be reasonably safe. And I can put a stop a little above there, something like that. That would have been very logical. But we'll take a look and see exactly what he did in a moment. So how did he do it? He might have noticed a pattern like one above, like I mentioned here, and then he'd calculate what would happen if prices went back up in those next few days. And he would typically find several reasons when he would talk about why prices were going to stop at some place or something like that. He would find several reasons as to why they would, and he would put his order in accordingly. And so this would be the basis of his orders in the scripts for students, that they could literally read to the brokers. So let's see this thing they read to the broker. Okay, here we go. This is the section of his newsletter that said orders indicated for the coming week. This is the exact newsletter. Okay, the top part. Okay, and this is the some information about actions from the previous week. Da, 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 da. That's all very nice, and how well he's doing. Here he's. I'm going to move these two around. Okay, what have I got here? Over here. Okay, here's the newsletter itself. Case study course letter applying scientific principles to price prediction. Back in 1970, and so you see this here. This is the results from the previous weeks and stuff, and how he's taken profits on this and loss on that, and da 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 da. And so, and here he says, so the total net paper profits for the past 2 weeks is about $2,000, and so assumed capital 5,000, 40% in 2 weeks, and it is usually an unusually high rate of over 1,000% yearly, much over the 100% rate that Kettner's book on commodities mentions is possible for well-managed accounts. Okay, then it goes on in orders indicated for coming week, and this is what you're to read to your broker. There you go. Cover June hogs at 25.10 order with your broker, good for the week. Take profit by sale of the August beef cattle at 31.20 for the week order also. And so he would do this, and then he'd have a little bit of discussion in here on some of the stuff. And so what happened was, I looked at this and went through it, and I really am not the kind of person that can sit there and go through every single order that he put in to really in detail examine it. I'll leave that to somebody else. I'm trained in something known as NLP, and that's kind of a different way of looking at life and things and doing things. So what happened is I looked at some charts, and this is a much more recent chart of something that ends in January 12, and I looked at some charts and I said, well, what did Andrews do? How are his techniques relevant, and how could this man have known 3 to 10 days in advance where to place orders? Usually it was no more than 3, but considering that you had the end of the week, the whole week in front of you there, it was really up to 10. So how could he have done that? How is that possible? Well, here's how. If you look at this chart here, for example, we can obviously agree that there's a high up here. And look at all the bars. I mean, this is weeks and weeks and weeks that this takes to get down here. And if this here is Thursday, okay, he can already have drawn a chart over here and verified for himself that this is very probably an important pivot point. And so as prices come back up here, he has what we'll call a signal number 2 and a signal number 3 to being true, and he'll enter there. All I really did was take his stuff and turn it into 5 signals for this particular exercise. And so what I did was I looked at this chart and I said, well, you know, where would a signal number 2 be true and a 235 be true and a 24 and stuff like that. And typically I was able to find several. Once in a while I only found one. There was one. But I typically find several. And so this is how he could have easily done this. So if, for example, this is prices, this is, let's say, Wednesday. This high here is Wednesday. The day after is Thursday. He sees it come down Friday. All he had to do was, in his newsletter, say, gee, next week if prices go up to this area here, I have these certain indicators telling me this would be a good place to sell. Go ahead and sell. But he would only do this after he looked at this chart here and verified that it met his criteria. And then he could easily have guessed that and calculated that he has signal number 1, 2, 3, and 4 coming in over here, and signal number 1, 2, 3, 5 coming in over here, and signal number 2, 3, 4 coming in over here. This is something he all could have done. So he's using this cluster of patterns that occur at, or actually right after, each swing point. And Andrews would first verify a swing point with techniques that he openly discussed in the newsletter. One of them, for example, was the ORE, and then there were other things. Okay. And so in addition to this script, he explained in detail how he determined the important reversals. Remember on this chart here, we had these very, very important reversal points, right? Well, so how would he do that? Well, what he would do is he'd send out a chart that kind of looked like this and say, okay, now here's how you draw these lines, and here's how you calculate them, and here's why you would expect a reversal at one of these lines. Okay. And this, by the way, are some charts that I posted on Andrew's course .wordpress. And as you can see, what happened was prices went up, boom, to the line exactly, and turned. Absolutely amazing. It flabbergasted me that it worked this incredibly well. So let's take a look at another chart, another thing. Here's another one, Foundation for Economic Stabilization. Here we're in November already. Let's see, when was the other one? The other one was in May. Okay. So here he is, and he's still doing his demonstration, or maybe a new one, and here is his orders indicated. Now here, in this particular orders indicated, he's changed his tune a little bit. He's doing a little bit more instruction, and you can see here, you can see buy and sell when prices meet turnaround lines. And then he gives examples in the orders, and this is so you'd put on, he said, well, on Friday you're going to have this turnaround line come in there at this value, okay, and then they're going to drop to this other one. So here's how to do it, and he gets a little more complicated so that people can start following his thinking. Okay, and so he would be doing instruction as he's doing this incredible marketing feat. And so I got to wonder, how would Andrews determine these important reversal points, after which comes the indicator number 2, 3, 4, and all that stuff, right? And also, how would Andrews select what to trade? Because remember, when he started doing his demonstration at any time, what he would do is he would select which futures he's going to be trading. He might only be trading 1 or 2 or 3 at a time with a $5,000 account. And so he had to have something very reliable that would say, okay, this is the one to start with because this is going to go the other way for a while. Okay, and so he would probably draw a chart like this here that we posted on WordPress, and this is an S&P chart back in August 2011, and so and what happened thereafter was prices went the other way for several weeks, and this is being able to do this would be something that was very, very helpful to him. Okay, let's move on, and let me get a quick sip of water. And let's review the answered quiz questions we have already. What is the source for the techniques? And the answer is the massive course material. You saw the table full of stuff. And discussions that I had with Alan Andrews, sometimes at his kitchen table, and our research. What did Andrews write was best for getting in nearest to a reversal point? And the answer is the OR method. See, and what he meant by nearest is, look at this here. This is real close. Okay. How could Andrews have known days in advance where to place orders? And the answer is by looking ahead to see where specific signals would be true in clusters. And he could have done this subconsciously. And that's my take on it. But the fact of the matter is, as we saw in this particular course letter here, he talks about turnaround points at turnaround lines at A and B and stuff like that. So I discovered this after I came up with my cluster theory. So wasn't so bad to be wrong. Okay, so to find a large move, what did Andrews look for first? And the answer was specific pattern reversals that he could know for certain would last for weeks. And then another important question is, how scarce is this expanded course? And the answer is well, there's 100 in total that are available, and there's a good number that are gone, that people have, and with the cost increasing with each one purchased. So in other words, the person who purchased the first one got it for a lot less than the person who purchased the fifth, and the person who purchased the 10th one gets it for a lot less than the person who purchases the 25th one, for example. Okay. Now there's questions yet to be answered. How many years did it take Andrews to make his first million? Why does the median line work? How can Andrews' methods improve Gann's techniques? If prices do not make it to the ML, what are the entry signals used to reverse? What indicators are useful for finding the end of a move? What indicators would Andrews use to add on positions? What indicators did Andrews use for buy and sell points? And how were stops placed? Straightforward. Here we go. Now, first question is, where did the median line start? And the answer is Professor Andrews was teaching civil engineering at the University of Miami. Sometimes he would discuss his previous life as a cotton trader and how his father wanted him to make $1 million the first year after he graduated college. And he told me personally that it took him 3 years. He couldn't do it in one. But considering that this was about 100 years ago, this was a considerable feat. And by the way, for his father to expect $1 million from him in income in a year is not unreasonable, considering the fact that he came from an incredibly wealthy family. Incredibly wealthy. So during class, the professor would discuss his relationship with Roger Babson, George Marischal, Birdseye, the frozen food guy, Zagorski, the helicopter dude, Morse, a relative of the Morse code guy. and others. Now, during a very friendly discussion with his attorney and friend Frank, uh, I was shown a picture of Alan Andrews. This is not relevant. Okay. Let's get others during class. And during the class, the professor might have discussed the Babson chart. And Roger Babson was publicly known for the Babson chart. His action-reaction theory at the time suggested that the area below the line was to be equal to the area above the line before things would move. So the theory goes, you add up the total square inches or whatever it is above here, and you say, well, let's say that's 56, and once you get to the number 56 over here, then this down move is over and up you go. Of course, as anybody can see, it was a guess, but that's really it. But what wasn't known to the public was that Babson discussed his theories in greater detail at regular meetings of the Gravity Research Foundation, where Birdseye, Zagorski, and others would join the young Alan Andrews in listening to presentations with their feet elevated in the air to minimize the impact of gravity. And this here is the stone monument that's placed at a place in New Boston, New Hampshire. And it says here, Roger W. Babson and his associates pioneered in active research for anti-gravity and a partial gravity insulator. And to this day, there still is a Gravity Research Foundation, and the Gravity Research Foundation collects papers from really smart folks like Stephen Hawking, and then grants these rather substantial awards for for what they deem as really great papers, and you can find them on the web. Okay, so let's see how this stuff really works. Here we go. At the meetings, Alan Andrews learned the steps necessary to determine probable future price reversal points that Roger Babson only discussed privately. Side note, if you read all of Andrews' books, all of Babson's books, even his autobiography, Action Reactions, you won't find what you'll get from me here in the next few minutes. You will not find any of these techniques shown to you in nice, crisp, clear detail. So this here is an FXI chart. That's the FXI is China, right? China ETF. And so what you might have done is you might have drawn a normal line, right? And then that's step one. And step two, after you draw this normal line, is you draw a parallel line from the previous price point, which obviously is up here. Right? And then what you do is you take the distance from this normal line up here, from this action line rather, to this normal line, which by the way is also called a center line. And you take this distance and project it down into the future to the reaction point. And here we go. And this is what it looked like on the weekly chart. Now, here's what's important in this. Real important for you guys that are brand new is that weekly charts and daily charts are really different. In the days of old, when you used to get a commodity magazine, you used to have spaces for holidays. And now everything's computerized, and so you don't ever get to see spaces for holidays. And if you think about it mathematically, when you're dealing with geometry, which you are here, if you don't have that space for a holiday and you throw in a daily chart, things are going to be a little off. Okay? And it seems like just a tiny bit when you think about it, but in the real world, it really is quite a bit. This is the actual chart that I sent out back in whenever this was. Let's take a look. Yeah, this was back in 2009. Okay, this is the actual chart that I sent back out in 2009. And at the time, I used a program called Precision Trader Software exclusively. And so I made the chart with this here. This is nice. It's really nice software. It gives you some really cool and accurate charts. And I give it away for free. Just go to, later on, sometime, go to my website at andrewscourse.com, and I'll tell you all about how you can get a copy for free. And after FXI made the bottom, right around here, waited a few months, and sent out this daily chart. And so as you can see, on a daily chart, it was much more accurate. All I drew was the center line and the reaction line. It was much more accurate in finding the extreme than this weekly one. Okay, and so if you draw these lines on daily charts versus weekly charts, you need to factor in holidays and not having holidays on charts. Okay, so this is what we sent out, and this has been the low ever since. That's kind of cool. Now let's get back to learning about action reaction lines. So you have this center line, right, or this normal line on this chart, for example, which is a very old gold bugs chart back from 2000 something or other. And then you just go back in time and you take a previous low and you pick an action point and draw a parallel line to the center line. And here's another one from a low action point, and here's another one from a low action point. And then you kind of flip that over into the future, and this is to give you some kind of idea as to where a reaction point is probable. Okay, here's a semiconductor index from way back when. I think this says 2005 or something here. This was good old Precision Trader 3.0. And here's your high, here's your low, here's your low point, low point, low point, flipped out into the future. Okay. Okay, so here we go. This is a daily chart, a much more recent one. Now, for you new guys, what's really important is that when people do historical tests on stuff, that they do it over, say, a certain time period. So as you saw a few minutes ago, these other charts and these other things that I did were done pretty much before 2009. They were done 2005, 2009, whatever, but they were done before then. So the question is always, well, if it worked back then, does it work now? Well, we're going to take a look. Okay, this is a gold chart, and so on the recent gold chart, this was January 2011. You just draw a peak to low line, right? And then you take the action point and a reaction point. And for this demonstration, we used an interesting little product called Q charts. And please, if you get this product, don't even bother looking for action reaction lines. They don't have a clue as to what those are. But I have a video that shows you how to draw all kinds of cool stuff that they don't have a clue about at Q charts with their software. So anyway, so you draw this peak to low and you take this action point and then you flip it over and you get this reaction point, right? And so here's another action point, and the reaction is going to be out there somewhere. So let's see what happens. Here we go. So here we have action line number 2, action line number 3. And now we're going to have the grand finale of this chart. Let's see what happens. You have to kind of condense it a little bit, but that's cool. Here we go. Here's your center line, here's your first action, second action, third action, and here's your first action, first reaction, second reaction, third reaction. Okay, now, first lesson about reaction lines. They are really, really cool for helping you to find turning points. But when you use them in time periods like I am here, which is really, this is a weekly chart that you see, there is no way in blazes how I am ever going to consider putting a buy or sell point in just because there's a reaction line there as the only reason. Totally nuts. I will tell you that right here at reaction line number 3, we also used another Babson line which came in right up here and posted it in real time to the group. I even might have put it to the public in the Precision Trader group, and you can join for free. It's a Yahoo group, and you get lots of email every week, and that shows you this stuff every once in a while. And so we did find the extreme here, and the particular indicator that we used in this area here to help find this extreme also helped to find the recent extreme, the highs in gold during 2012, the highs here at the beginning of 2012 in gold, and what looks like a high in Apple at this point in time. Okay, and once again, here's a chart with the Babson lines, right? Peak to low, action, 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 reaction, reaction, reaction. Now let's get back to our story. So the story is that Professor Andrews is in his classroom and he's talking about Babson and how to draw action-reaction lines and stuff like that. And let's assume for a moment that the kids are actually wide awake and that they have lots of very intelligent questions. And if they did, one of them might have asked a question like, well, after prices pull back to a reaction line, how do you know when to buy? And we're going to maybe even give you an answer in that in a little bit if you pay attention. And how do you know which type of center lines to draw? And a rather interesting question, if prices break past a reaction line and go to the next one, how do you know they are still with the trend? And so what happened was the median line was invented. One of the kids in the class said, well, look, if you need to use statistics to project prices of something, what you do is you take data here, these little blue dots, and there's this nice mathematical formula that you use. I guess they didn't have Wikipedia at the time, but you can find it on Wikipedia now. Just look for this chart. And what you can do is you can take this data here, and you can, as a result of this data and this mathematical formula, draw this line. And then all you do is project it out into the future, and you will get the probable trend. And he said, and all this really is a regression line, and this regression line is also known as the median line. And then he said, and somebody figured out along the way that if you draw parallel lines with it, which Professor Andrews called MLH lines, then what happens is you get something like this. So in other words, if you have this much data here, you can draw this whole thing and project out into the future. And if you want to do this mathematically, because let's say you have a broker like Interactive Brokers, which really doesn't let you draw median lines or anything like that, here's the magic trick. Real simple. You find the high here, you find the low here, you find the 50% point. Right? Practically all software has this 50% thing. So you find the 50% point. Practically all software lets you draw trend lines. So you draw a line from here through this 50% value point out into the future, and that's your median line. Then what you do is, like most software will actually let you draw parallel lines to trend lines, and then you draw this line here as your parallel line from this point here, and draw this line here as a parallel line from this point here, and voila, you have the Andrews pitchfork. Okay, so anyway, what more than likely happened after that was Andrews researched the median line, and the parallels and stuff. And he wrote about it, and he found that prices hit the median line nearly 80% of the time. And under specific conditions, when prices did not make it, a powerful move would go in the opposite direction. And also, when prices zoomed past the ML, they would go back towards it and then go much further in the original direction. Let me show you some examples of that. This actually is kind of interesting. This is zoom, retrace, then further. You can see here, low, high, low. Prices zoom through the ML, retrace back, and go further in the original direction. Isn't that cool? Let's see another one. This is the recent silver chart. Beginning of the year, January 2012 in silver. Yes, it still works today. He wrote about it back way back when. Prices zoom through the ML, retrace back, further in the original direction. But does it work intraday in the S&P? Oops, wrong one. Well, this was back in December 2011, not too far away. And you can see here, this was an ORE point, and here was an OR point. And prices zoom the ML, retrace back, and then went further. And what was also interesting was that if you draw your, that was the old ML, and if you draw a new ML from high, low, high, prices also came down to the intersection of a couple of MLs. Okay? Kind of neat. Andrews, by the way, Andrew said watch for turns when you see a couple of MLs like this coming together. Okay, so what happened was Andrews developed a course, and to market the course he would advertise in Popular Mechanics and other magazines, and he would send responders to his advertisement a weekly course letter for a while, and the idea was to get people to take his course and send him a whole bunch of money. And back in the 70s, there was times when he got $1,200 for the course, and then it was $1,500, and then it was $5,000. It was not cheap. And this was the 1970s, and remember at that time minimum wage was a lot lower than it was today, so it's like you multiply that times 5 or more, and that's what you get. Yeah, gold was $30, $35 an ounce back then, wasn't it? So he would send responders a weekly course letter. In the 1970s, his weekly letter contained a script to read to the broker where he turned $5K into $50K in a few months. Heck, if that was part of the package, that would really move today. You know? So anyway, Andrews, like myself, is not a broker and really interested only in the education of the students. What you'll find today is that if you look on the web, with myself being an obvious exception that has no ties to directly, indirectly, sideways, anyways, to a brokerage firm, nearly everybody else out there has some kind of connection to a brokerage firm. I guess that's where the money is. Okay, so in the 1980s, he suggested that I teach the course on the West Coast. And yes, I do live on the West Coast, where all the loose stuff hangs out in California. I used to live in Silicon Valley, and now I'm in a little bit of a warmer climate called San Diego. Live someplace where I have a backyard on the lake. And I developed software for the Andrews technology called Precision Trader. And I was fortunate enough to acquire the massive library of the Andrews techniques and course letters. And if you want to see this massive library, which you kind of saw a few pictures of earlier, you can now see it by going on YouTube and searching for The Treasure of Alan Andrews. Okay? Where are we? Here we go. Oh yes, there is a limited availability. We teach two courses. One is something called the advanced course, and that's like it's a lot of material. It includes a manual, it includes over 30 videos and all kinds of good things. And then there's a very limited number of expanded course members, and that'll be up to 100 in total. And these are people that really want the whole shebang, and they want all the originals and all that good stuff, and they get that a copy of the massive expanded library, and they get to be in the discussion group for that and all this other stuff. And in this advanced group here also has a discussion group. So later on, when you get a chance, go to andrewscourse.com. Okay, and there you can sign up for free information, and you can sign up for the course if you like. Now let's learn some more stuff. Hagopian's rule. Hagopian's rule. Okay, well basically Hagopian's rule is that sometimes prices don't make it to the median line. Okay, and where the heck is Hagopian's rule? Did I have it in here? Anyway, Hagopian's rule is sometimes prices don't make it to the median line, and when they do not make it to the median line, they go the other way. Simple enough. And the theory is they'll even not only make it to the next median line, but they'll even make up for it. Interesting theory. So anyway, how it works is you draw a trend line here, and if prices come down to the median line, don't make it, and break above it, then that's a Hagopian buy signal, and then what happens is what happens. Now, truth of the matter is that if you look where this prices went past this little line here, and this over here was a whole lot of bars, and that's almost a month. And so whoever followed Hagopian's rule in this particular situation here got to hang out with a whole lot of downdraw for a month, and that's what you read on the web, and that's what some guy in Chicago teaches, yada yada yada. Okay, and remember, that's what all the good old brokers will teach you. Okay, now if you take the advanced course from us, for example, one of the things that you would see, or the expanded course, is that you would see a video from Dr. Alan Andrews, and he says, yeah, I'll say, yeah, you get to do this, and there you break that, and he says, but you really don't buy there. That's not a good idea. What he says instead is that typically, after they don't make the ML, there's typically a 3P line that you draw. So there's a low pivot, and prices come back down to that 3P line, and that's where you buy, and that's a lot more comfortable. Right? This way you don't get to hang in there with one of these crazy down draws. And that's not a bad idea. We have a signal that we use. This one's called the WN. This one's called something else. So you could have used our signal that we teach in the advanced course and the expanded course. That's over here and over here. Okay. Let's see another example of this Hagopian's rule. Here we go. Okay, so here we see the Australian dollar versus the US. Prices come down to the median line, don't make it. Theory is that prices are going to go up very, very strongly and make it to the next median line. Theory is. Okay. Fact of the matter is that had you drawn your trend line, right, and here, and entered the market here, prices would have came down a little bit, and on and on and on. But you also could have easily drawn a trend line, like Alan says, low, 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 and when they break down, when they come down and hit a 3P line, away you go. Okay. And had you used our technique, the same thing that would have gotten you long, and the other one would have gotten you long here, at this point here, and so you could have gotten long here. So that's the difference. Okay, and on my numbers 1, 2, 3, 4, 5, this is a number 1 pattern. Okay, let's move along. Andrews and Gann. Now, as many of you know, once upon a time there was a man, there was a very famous trader named W.D. Gann, and he discussed a technique called the head and shoulders technique. And so the idea is that you simply look at patterns, and you see in the market, every once in a while you'll see a head and shoulders, and here's a head, here's a shoulder, and then this here is a neckline. And my very limited understanding of Gann is that, excuse me, drink of water time, is that how this works is when prices break below this neckline, they then will move a distance that's equidistant from this low here to the tip of the head. We'll show you that in a minute. Bada bee, bada boom. So here it is. Here's your Gann target, right? And as you can see, prices broke through the neckline and everybody's in there selling. Prices went down to the target and they got out and bought. Okay. Now what Andrew says is, Andrew said, well, if there's a significant move, okay, first of all, when it comes to target, there'll typically be 5 waves. So you don't have to just get out at some arbitrary point like this. There'll be 5 pivots. And so here might be pivot 1, 2, and then 3, and then 4 and 5 or something like that, right? And also what he said was that you can use something that I call the Danish golden pivot rule that would have gotten you short right in here, right? And I do take credit for the Danish golden pivot rule. We teach that. So what happens, or you can use other things that you might know from other techniques, get you in here. What's important is that once you get in on a head and shoulders pattern, that you typically look for 5 waves. Let's take a look. Here we go. So on the way down, you might have drawn your modified shift median line or regular median line. We'll show that in a second. So here's your Andrews point, and here's your standard Gann. And so prices went down, just going down really, really fast. Here's your Gann target. And like I said, here's 1, 2, 3, 4, 5. Real easy. And so what happens is your Andrews exit area is down here. Here's your standard exit. Here's your standard Andrews line. Right? And there's your Andrews pitchfork, your Gann target line, and your 5 pivots. And so there you had it. That's how to combine Andrews and Gann, made very easy. Let's see another example. Okay, here we go. This is a weekly chart. And so what you have here is you have your shoulder, head, and upside down head and shoulders. And so you draw your line, which is, here's your Gann entry right over here, and here's your Andrews entry with your golden pivot rule. And so you go, and so you have 1, 2, 3, 4, 5. Now the Gann area was somewhere up here, okay, and that was pretty good profit on a weekly chart. And Andrews would have taken you up a bit more. Okay. Now, this was in an article I wrote up for Traders World magazine, and the reason why this was on my mind was because of this. At the time, we were looking at this much data here, and in our discussion group, which was last year in the summer, I guess, we were talking about head and shoulders patterns and using Andrews and what to use with it and stuff like that. And I said, well, by the way, it looks like you have one in the SPY. And sure enough, so here's your neckline, here's your head, shoulder, and here's your 1, 2, 3, 4, 5. Simple as that, right? Now, what I also did at the time was I draw a weekly chart because it was a lot easier to see, and I posted this. I think it was on WordPress or something like somewhere. Who knows where I posted this? But I posted this chart, and with the idea being that you can use these target lines, which are kind of like action reaction lines, right? Even though it looks like a pitchfork in the middle of nowhere. And so here's your shoulder, here's your other shoulder, and here's your entry area, and then of course here's you would draw a line here which gets you the short, and the idea being that you'd have 5 waves, and one of those 5 waves would effectively end, if all worked perfectly, on one of these target lines, and then things would reverse. So let's see what happens. There we go. Here we go. One. So we have 1, 2, 3, 4, 5. Made it down the third target line, and away she went. Right now, one of the interesting things is that we're known for sending out charts with to people who were in the Andrews group, and there's the advanced Andrews group, and they discuss this kind of stuff. And then there's people who just kind of sit there and watch and just want to see stuff for free or something. And those are in the precision trader group, and sometimes I'll send out charts. And here's one that I sent out in October of 2011. And what I do is I put a bunch of numbers, and there'll be a bunch of numbers on a chart, and sometimes I'll put a few letters in. And there's a number of reasons why I do that. One is that people who've taken the course from me know that when I put a bunch of numbers on the chart, there's a whole lot of stuff that I saw in here. Okay, what I do is, rather than send out a chart with an ridiculously overwhelming amount of lines on here, which just drives people crazy because they can't figure out what's going on, is I'll just draw 1 or 2 lines sometimes, and for the most part put a bunch of numbers over here. And these numbers are really useful for me because it helps me to understand what it is I saw when I saw this chart. And those AAAs, well, that was my opinion, but this here was my numbers, which tell me what I saw over here and where this little arrow was. And at this point in time, looking at these numbers, I can tell you that I saw an ORE over here. And this is what happened afterwards. Oh, time for a glass of water again. Okay, just out of water. This presentation better be over soon. Okay, here we go. So next question, what exactly were the buy and sell signals Alan Andrews taught? Number 1, he taught about the mini median lines. Now these are drawn from closes, and they use MLH lines for stops. Let me give you an idea how this works. What he does, or what he did, is he would look at charts and he would look at where the closes were. And sometimes you get these extreme closes, and those were the ones that were important to him. So here's a high close, here's a low close, here's a high close, here's a low close, here's a middle close. Ignore that. Here's a low close, here's a low close. So if it was a second low close, he would take the further one, and then here's a high close, middle close, low close, high close, etc. So what he would, let's say over in this area here, he had one of his indicators, maybe his ORE or something, that told him, hey, it was time for prices to go the other way, and or a turnaround line, his TALs. And what would happen is he would draw the mini median lines. Now mini median lines are not drawn from extremes, they are drawn from closes, and they are drawn from alternate closes. So if he was looking at this low here, and on right here before here was a high close, he would draw it from this close to this close to this close. See? And then what he would do is, after he determined this here was a place that was very likely going to go the other way, he would draw his lines, and he would use an entry that was beyond the far H lines. That's why when you read his original works, where you see his rules, it says put your buy in past the MLH, and then you use the other side of that for your stop. Okay, so this would have been your buy over here, and after prices went up, you'd see your high close, low close, high close. And let's make believe for a moment that up here you had something that told you this was the high and it was going down for a while, maybe an ORE, maybe a TAL, whatever it was. Then what happens is you simply draw your median lines and parallels from your 3 alternate closes. So here's a low close, here's a high close, here's a low close, and you would use that, and after prices broke through, kaboom, there's your sell. And that was his rule on using mini and median lines for entries and stops. So in other words, after he got in, he would use the other side for his stop. So, and if he bought here, for example, he would use this down here for a stop, and that's pretty tight. Okay. Now, personally, my favorite signal when I was doing experimenting with the ORE, I was just flabbergasted by it. Started experimenting with it a little while back, and this was July 2010 or so, July, August, and this was the low in gold, and I was just fascinated that after seeing this signal that prices really went. And I found out, to my surprise, that while the ORE is an interesting gizmo for finding turning points, if you combine it with certain other indicators, it gets a lot more interesting. So that's why you see all the numbers on the charts. And give you an example of what I've been able to do with this kind of stuff. This is my alphanumeric soup down here. Right here are my numbers, and here's my guess as to how interesting this would be. And so what happened was, this is a weekly chart of Magic Investment Corp that I sent out, and price was at about $2.70, and I was looking for prices to come down to this little blue line here. This little line in the middle is a little target line. Right? Now let's move on to a daily chart. And a few days later, prices went down here and they reversed. Now there's ORs, and then there's Janus reversal line. A Janus reversal line is typically a big old OR, and meaning that that's when it's going to go for a while. And so they did go down here very nicely and then reverse. And so the theory is that prices would go up here for a while, right? If you remember, on this chart here, we were at $2.70, and over here we're at $2.55 after, and prices down here were probably around $2.40 or somewhere, right? So, and what happened afterwards was prices went up rather nicely. Now we're going to go and answer one more question for the quiz. How did Andrews make his huge gains when he did the 5K to 50K? Well, in one of the demonstrations that I studied, was what he would do is he would find a major pivot, and he'd enter at this major pivot, and then after prices came back down, he would enter additional positions like over here and over here, because when they came back down, they often came back down to reaction lines. That's the answer. Okay, so let's move on to the quiz. The quiz. How many years did it take Andrews to make his first million? The answer is 3. Why does the median line work? It's a regression line. How can Andrews improve the head and shoulders techniques? Better entries, better exit. Oh, need the last drop of water. If prices do not make it to the median line, what are the entry signals to reverse? Andrews said a 3P line. Prices pull back to a 3P line, so you've got a good reference point and a very tight stop. Advanced and expanded course members look for textbook patterns. They can also look for 3P line if they really want to. What indicators are useful for finding the end of a move? Answer is, I showed you reaction lines and certain other Andrews techniques. What indicator would Andrews look for to add on positions? When prices came back down a little bit, the reaction line was the first thing he would look at. What indicator did Andrews say to use for buy and sell points, and how were stops placed? The answer is mini median line parallels drawn using closes, not extremes. What is our source for the Andrews techniques? The massive expanded course materials, discussions with Alan Andrews, sometimes at his kitchen table, and our research in the massive volumes of Andrews' writings. And as I saw this thing here at the kitchen table, I was reminded that when Andrews would talk about his kitchen table, he would mention that the Marischal charts, which apparently he must have had there at times, were too small for the kitchen, were too large for the kitchen table, so he needed a bigger kitchen table to do the Marischal charts. Maybe I won't put that in the real presentation. Okay, so anyway, now moving on. What did Andrews write was best for getting in nearest to a reversal point? And the answer is the OR method. How could Andrews have known days in advance where to place orders? And even though I found out along the way that that's not exactly what he used. He used TAL lines and some other things in there that are in the notes. Is near what I think he could have used theoretically is by looking ahead to see where specific patterns would be true in clusters. Okay, to find a large move, what did Andrews look for first? Well, first he would do is he would look for reversals at major pivots that were easy to forecast with his methods. And the final question is, how scarce is the expanded course? And the answer is only 100 in total, with the cost increasing as each sale is purchased. With the cost increasing as each is purchased. Oh, okay. Anyway, this says this stuff on the bottom. Okay, let's get rid of this. Well, we are done. I thank you for your time, and this was a good practice session for a presentation that I'll be doing.